Welcome. I'm Mike with another episode from Penner Investments today, and I'm going to be discussing how I pick and evaluate individual stocks. This is an important concept because there is much more risk in individual stocks as compared to investing in a mutual fund or an index fund, as they may be diversified over 100 different stocks in their funds. I like to invest in individual stocks in my brokerage account and also a portion in my IRA. I try to keep around 70% of my investments in index funds, as the risk for purchasing an individual stock is for that company to report bad news and the stock price dropping significantly. And that's another reason why I only invest in solid and financially sound companies. I stay away from the high-flying stocks and companies I have not heard of or don't have an understanding of. I like to stick with companies like the Apple, Microsoft, Nvidia, Bank of America, and Chevron, companies that you've heard of, and these type of companies allow me to sleep at night, not worry about having any risk of them going out of business tomorrow. I know Apple's going to still be around next week. I don't have to worry about losing the value of my investment. Now, the important part is how to evaluate a company and decide if you should purchase a part of it. When you buy a share of stock in a company, you want to think of yourself as an owner of that company, because this is what you are. This is the philosophy that Warren Buffett talks about and teaches when it comes to investing. If you like this content, be sure to hit the like button and subscribe to my channel so you don't miss out on any future content. One of my favorite websites to use for evaluating stocks is Yahoo Finance, and the nice thing about it, it's 100% free. I put in the stock ticker that I'm wanting to research, like type in Apple, and then I click on the statistics tab for the company that I'm researching. The first statistic I like to look at is profitability. Is the company turning a profit after it has paid all of its expenses? Here I look at the profit margin, and for an established company, it should be a positive number. If it's a negative number, it's either a new or emerging company, and I'm not willing to invest in anything that's not turning a profit. I really like to see a minimum of 10%, but prefer to see around the 20% or higher range. The next statistic I look at is return on equity. Equity is the funds that are provided from your investment when you buy a share of stock in the company. This measures how effective the management of the company is utilizing your investment. I like to see this number around 20% or higher as well. The next item I look at is the balance sheet. This shows me how financially sound the company is doing by looking at the total cash compared to the total debt. This is similar to how a financial institution will look at you before they'll give you a loan. They want to make sure that you can afford to pay back the loan before they're going to give you the money. I do the same thing when I'm looking at buying a stock here, buying a portion of the company. I want to make sure the company can afford to make their payments so I don't have to worry about my investment going down. I like to see the total debt not being more than double, or not much more than double, of the total cash that they have on hands. Cash-rich companies like Apple have almost twice the cash as debt, which is a really good ratio to see, way better than average. And then if you're investing in a company just simply for the dividend, or companies that pay the extremely high dividends, the 4 or 5% or higher per year, one statistic you really want to look at here is the payout ratio. This will be under the dividend and splits column when you look at the statistics. And the payout ratio, what this is showing you is the percentage of each dollar that is being paid out in dividends. If you're buying a company simply because it pays out high dividends and this number is at 100%, you can rest assured that the dividend payout is not sustainable. This means they're paying out 100% of every dollar that they've brung in after paying their bills, and then they have nothing left to grow the company, or if the company runs into troubling times, and the first thing they're going to do is cut the dividend payment. So what you really want to do is look at companies with the lower payout ratio for the dividends. The lower the better. When looking at the price of a stock, I use the PE ratio, or price to earnings ratio, to give me an idea of how expensive a share is compared to the earnings of the company. This number is typically higher for tech and growth companies, as the expectation is that the company will continue to grow and be worth more in the future. The lower the PE ratio, the better. The current PE ratio should be compared to the historic PE ratio of that company. PE ratios below 15 are considered cheap, but this is only one statistic to be used in the evaluation of a stock. By looking at the historic PE ratio, you can kind of see whether the company is trending where the stock is getting more expensive, or kind of like where we're at now, where the economy is not doing very well, and PE ratio should be trending down as stocks are cheaper to buy right now. PE ratios below 15 are considered value stocks, which have been the backbone of the investing style of Warren Buffett and other value investors. Growth stocks are identified with having a 15% or greater return on equity and having a 15% projected growth over the next 5 years. And again, the nice thing about Yahoo Finance is that I can see what the analysts that track certain stocks have evaluated the growth estimates to be under the analysis tab. While this is only an estimate, this is what the professionals are estimating. This shows me the growth estimate over the next year and the next 5 years. On this statistic, I like to see that the company has an estimated growth above 15%, and then over the next 5 years, I'd like to see the number at 15% as well. Well, these are just a few of the statistics I look at and give you a big picture of the overall company. And remember, only one statistic only tells part of the story, so you want to look at all of these statistics and numbers when you're evaluating the company. Thank you for watching, and have a nice day.